I don't think anyone can draw any firm conclusions about it at the moment. Clearly, improving the productivity of the public sector would be important to improving the quality of services that people receive from the health and education sectors and elsewhere. From the point of view of our forecasts, when we're trying to assess how much, what's the tax generating capacity of the UK economy and how much people are paying in tax, it does matter more what they are being paid than what they're delivering in terms of services. But clearly the quality of the services matter for other people's ability to get back into the workforce and contribute to employment and tax receipts and those sorts of things.
Yeah, so just to be clear, I think it's good that we are trying to measure it more accurately, but it does make us different to others, and it just adds to the question mark again over whether Britain does have a unique productivity problem compared to others. Is this real or is this measurement? Do you have any sense of that?
When we looked at it, what you found over the course of the second half of last year, which again I think leaves you with more questions than answers, is that the slowdown in productivity was pretty broad-based across sectors, both public and private. And it included some big employers like hospitality. So it wasn't obvious that was the sort of slam dunk, as it were, to explaining the productivity puzzle. Oh, it's just the way we measure productivity in the UK, and it's just that we're better at doing it in the public sector. It does seem to be a mixture of measurement challenges, real effects, real sort of whole economy effects, and then possibly something around sectoral mixes. It's something which we will have a further look at between now and the autumn.
Thank you.
Thank you. Lona McAvoy.
Thank you, Dame Meg. Just a very quick one from me. So just going back to GDP and the way that we measure productivity. So the household expenditure is the largest section of GDP. So is the productivity problem linked to the cost of living crisis and the cost of living crisis scarring? So we know wages are increasing, but that'll take a bit of time before people feel better off. So could we envisage a scenario where actually household expenditure goes up, people start spending more, people are feeling better off, and we see an increase in GDP because of that, which would then support a better productivity rate?
I think it comes back a bit to the issue about slack in the economy. If what is holding back right now, to some extent anyway, economic activity, GDP, is that demand has fallen a bit short of the supply capacity of the economy, then anything that boosts demand will boost GDP. There may not be a big increase in employment, but it would show up in productivity. I mean, in fact, that's one of the reasons why our growth rates of productivity, in the eyes of some people, look a bit optimistic, because maybe some people are not factoring that in. So I think there's something of a link between demand, confidence, and productivity. I mean, that stops working once you've got up to full capacity, where you need other things to boost productivity then.
Thank you very much. John Glenn, MP.
Thank you. Could we turn to tariffs? Last week, President Trump announced tariffs on car imports. If they'd been in your forecast, would all of the Chancellor's headroom have been used up already?
I can do a quick one, but
you go.
So, I mean, just on that specific question, we looked at a range of scenarios around tariffs. What the announcements on cars last week amounts to is sort of elements of that downside risk materialising. But we export, as of 2023 data, about £60 billion worth of goods to the US. About 6 billion of that, so 10% is in the form of cars. So that announcement didn't affect the whole of our goods exports to the US, but it is elements of that downside scenario that we had included in our forecast materialising, and we'll see whether more of it materialises.
Is anyone who might be following Chart C in your Blue Book covers this?
But I think that the key issue, I mean, it's dominating the news today, is what effect will these tariffs have? And I appreciate it's in the context of ongoing conversations, and the business secretary is obviously anxious to say that we don't want to do anything that's going to precipitate a worse outcome. But when we look at your central forecast, given that's the one that's obviously most likely to happen, why did you exclude explicitly? You didn't include explicitly tariffs in it. And given that, obviously you can't be expected to do something that happens the day of or the day after, but it would have been surely reasonable to expect that to have been set out more explicitly.
I guess, two reasons. One is that our forecast has to be based on a forecast for the global economy. We've got 50 odd people in the OBR. We can't maintain a full sort of global economic model the way the likes of the IMF and the OECD can. So we, like the Bank of England and other forecasters, rely on the IMF's World Economic Outlook as our global economy forecast on which we base things like UK exports and imports.
That doesn't incorporate the recent changes.
So the last one from that was in January, and they did not take account of US tariffs. The second reason was, but you saw from the box that we published in the EFO, which was box, I think it was 2.2. We did do our own scenario modelling of what the impact of US tariffs might be on the UK economy, including 3 different scenarios depending on the escalation of tariffs. So we did want to make sure that we were transparent about what the possible effects might be. The other reason to not take account of US tariff policy is it was changing every day, depending on what phone call the president had with one or another head of state. And so in that sense, it was very hard to choose what day's tariff policy in the US to really reflect on our forecast. And so in light of that, both for the reasons of consistency with the IMF WEO, but also the fact that tariff policy was changing, we thought it was best to keep US tariffs out of the central forecast, but make it very clear what the delta would be if you saw higher tariffs on other North American countries and China, 20% additional tariffs, and then 20% additional tariffs with reciprocity from the rest of the world.
I mean, I recognise that's a very fair depiction of the uncertainties, but nonetheless, obviously, you are the sort of arbiters, as we discussed earlier, of what government policy is, which has also got to evolve in real time. I think we're going to see some economists this afternoon who have incorporated tariffs into their forecasts. And indeed, obviously, private sector organisations have been informed that Vanguard, for example, have put them into their forecasts. Do you think we'd be wrong to conclude that we should expect to have more from the OBR on this sort of critical element of how the economy is going to perform in the coming months, to have more forward-leaning expectations around the impact of tariffs?
I think you've got a complete assessment, and I'd really encourage you to read Box 2.2, as well as we did a full assessment of their fiscal implications at the back of the book in terms of what they mean for the current balance and net financial liabilities. We're the first official UK economic forecaster to do this work. We've done it with 50 people. And so I think
more people to
I'm very happy with the people that I've got. We do our best to satisfy.
Everyone always says that. But do you need more to be at the cutting edge?
We do our very best to satisfy this committee's very high expectations of us. We also compared ourselves with trade modelers around the country who've made similar official estimates, and so far we're the only ones, official forecasters who've done it.
Okay. So, if I perhaps turn to your colleague, Professor Miles, I mean, I think the theme that we're finding is that there is a grave amount of uncertainty in world trade policy, and obviously the countermeasures that respective countries that are most impacted take is also difficult to compute. Is it fair to say that we should view all economists' assessments of future trade policy and the economic consequences with some considerable trepidation at the moment?
Well, I think one could be fairly confident that it's not good news for anybody, frankly. So that's a very weak statement and is blindingly obvious. Actually, even there, it's not quite so obvious, because let's suppose there's a very limited tariff war. So it's China, Mexico, Canada, the countries that are already, it's pretty clear what Trump is going to do. And that's it. And the UK stays out of it, and so does most of the rest of the world. It wouldn't be unreasonable to think that could be, if anything, very, very mildly positive for the UK, because there's a bit of trade that will get diverted to the UK, and some of the exports from China, for example, that would have gone to the US, they'll be looking for a home for them in the rest of the world, and stuff will be available in the UK a bit cheaper than otherwise would have been. So there is one not central scenario at all, which is very, very mildly potentially positive for the UK. All the other ones, which involve the UK facing tariffs, are negative, and they're negative to very different extents. And if tariffs at 20-25% were put on the UK and maintained for 5 years, our assessment of what that does is that it will knock out all the headroom that the government currently has. So had we made that a central forecast, and had the government not changed policy at all, knowing that we were going to take that as our central forecast, then the headroom would have pretty much all gone. Of course, that would have been, in some ways, a very extreme assumption, because not only would that be as bad as people might expect in the very near term, but it would have been maintained for 5 years, which is, you know, beyond the next presidential election in the US. So I think that's at the pessimistic end of the.
Carry on.
Sorry.
Could still be there if recent reports.
Apparently so.
Do you help the committee and help those watching to understand what assessment you make beyond the tariff policy of the Trump administration in terms of broader economic policy, how that's reflected in your assessment of the impact on the UK economy, and, you know, how does the UK economy respond to the sort of other elements of Trump's trade and economic policy?
Well, I think it shows up a bit already in surveys and confidence, particularly the ones that have come out in the last couple of months after the new administration's there in the US, and it becomes, I think, a bit clear to everybody that the tariff stuff looks like, to some extent, it's going to happen. And they have affected our assessment of the near-term trajectory of the economy, and we've talked about the downgrade to, you know, 1% growth this year rather than 2%. And that was quite heavily influenced by particularly the business confidence surveys that have come out just in the last month or so, which have been very, very weak. Beyond that, I think it's very hard to come up with an assessment of what the impacts of government policy in the US might be, for the reasons Richard was saying. It's very hard to work out what they might be, and they change, you know, not just by the week, but by the day.
Yeah. Can I just ask you as a last question? You mentioned the business confidence surveys then, and my colleague Dame Harriet Baldwin mentioned it too. Given some of them were too proximate to the autumn assessments you made, given the experience you've seen over the last 12 months, will you be factoring those into your assessments going towards the budget with you know, greater interest in those surveys, given that they proved to be materially consequential to the actual outcomes of this spring assessment?
I mean, I think it's fair to say that we always look at the surveys, which tend to tell you something about where businesses are right now and what they might do in the next 6 to 12 months, about hiring, about investment intentions, and that. So I think we were mindful of those in the lead up to the October budget. I mean, they just moved a lot subsequent to that. Now, in a sense, I think you're spoilt for choice in terms of interpretation of that, because there are a lot of things that happen, most of them which are pretty negative. Interest rates, energy prices, a growing realization that the US administration might go ahead with stuff that people had thought before, well, that's just noise, they're not actually going to do that. So what I would say is that we pay a lot of attention to them for the near-term outlook, but a lot of those surveys really are about asking companies and consumers as well, how do you feel right now? What are you going to do in the next 6 to 12 months? Rather than, you know, where do you think you will be 3, 4, 5 years down the road?
They are material to the growth forecast that you're predicting for the next year. And
yes, for the near term, absolutely. Yeah.
Thank you very much.
Well, certainly going to be an interesting forecast in the autumn, with depending what exactly happens tomorrow. Bobby Dean, MP.
Thank you. Ms Hughes, I'd like to go back to the fiscal headroom question. I think the thing that struck everybody was the restoration to precisely the same figure that we had before. So it doesn't really look like the natural output of policy reforms that have been scored. It feels like that figure was targeted. Is that the case? Did the Treasury ask the OBR for a balancing figure and then they went away and found their way towards it?
No. I mean, you'll need to ask the Treasury quite what they were trying to achieve, but our forecasting models are very transparent. The Treasury understand how they work. The policy measures which they used in the end have quite a direct effect on the level of headroom in the final year. So in that sense, The Treasury, we aim to be transparent, predictable, boring, and understandable. We're not in the business of trying to surprise anybody, be it the Treasury, be it markets, be it yourselves. And so we are very transparent about the mechanics of our forecasting and how they work, how they respond to changing different fiscal levers on the tax and spending side. So the Treasury do understand how our forecast will respond to changes in the post-measures picture, and you'll have to ask them why they decided to get the outcome which they got.
I'm sure we will ask them. I mean, in effect, though, if we're striving towards a similar figure, does that not de facto change what the fiscal rules are? Are we not actually just seeking for a 9 billion surplus? Would you expect to see the same happen again in the autumn, or?
Again, it's a question for the Chancellor. One thing I would just stress is that number is extremely small.
Yes, 1%.
It is 1% of total revenue and spending. It's in 5 years' time. It's akin to asking somebody who is on sort of average earnings to forecast how much they're going to be paid and how much they're going to spend in 5 years' time to the nearest £200. An awful lot can change in 5 years' time about your employment prospects, about your lifestyle choices, about the pressures on your household budget. And so trying to predict with that level of accuracy where you're going to end up is very unlikely to be successful.
And so I guess on that, is that do you feel like this is a useful thing for everybody to be focusing on, this measure within 1% of overall spending? Do you think there should be more flexibility in that? Obviously, you could gain flexibility by having greater headroom, as you remarked earlier. There used to be much greater headroom traditionally in these forecasts. But you could also do that with change of rules. Do you think that would take some of the heat out of the public conversation around this if there was more kind of flexibility around this?
I guess two things that we're at pains to try and do every time we present forecasts and wider publications is stress the uncertainty around our forecasts and the sensitivities to key judgments, as well as scenarios around key sources of uncertainty, as we did in this forecast around productivity, interest rates, and trade, and really try and draw attention to the fact that we know better than anybody how uncertain the future is and how likely our forecasts are to be wide of the mark in one direction or another, and the importance of understanding what might drive that and think about how you might respond if you end up in those different situations. I think the second thing which we try and really stress is that in addition to doing medium-term forecasts, we also do longer-term fiscal projections, which in many ways tell you some more important things about the outlook for the public finances, which is, in the face of an aging society, with all the pressures on the public finances that generates, public policy and public debates about public policy need to also respond to those longer term trends, not just where the economy might be headed in a given 5 year period, which can depend an awful lot on what are essentially transient factors, be it the level of interest rates, the cyclical position of the economy, what a particular US administration is doing.
Thank you very much indeed. John Grady.
Yeah, thank you very much, Dame Meg. Just continuing the discussion on headroom. Mr. Hughes, in your presentation on March this year, you said, the spring statement breaks a historical pattern of asymmetric policy responses to forecast changes in which windfalls were generally spent, but shortfalls were not fully made up. So against that background, do you support the Chancellor's approach of confronting the reduction in headroom immediately in this way?
I mean, we don't endorse any policy decision by the Chancellor, but I think the point I was making was that, from the point of view of forecasting the public finances, in a world where shocks are inevitable, how policy responds to those shocks matters for the accuracy of your forecast and the likelihood of actually a government meeting its fiscal rules, which is the thing which we ultimately have to assess. And if governments have an asymmetric response to shocks and they spend upsides but they don't adjust for downsides, then you will end up in a different place from where you are forecasting. And so from the point of view of, we get lots of criticism for our forecasts turning out to be wrong. Well, one of the reasons why they turn out to be wrong is asymmetric responses to shocks. Governments spend windfalls, but they don't adjust for, we don't have a good word in English for the opposite of a windfall, but when for downsides. And so for that reason, one thing that provides you with can help secure the trajectory of a given forecast and reduce the risks around a given set of fiscal rules is if the policy reaction to a deterioration of the forecast is as symmetric as the policy reaction to an improvement against the forecast.
And I suspect, when you're looking at your own finances, you would try and adopt a symmetric approach to such shocks and windfalls, wouldn't you?
Well,
Properly advised.
I'm trying to think back about whether I have. Probably not as much as I should, I suspect.
Turning now to chart 7.2 of your report, what we see there is headroom averages 30%, but after Mr. Sunak's last budget, March 2022, it's now around 10 billion. Sorry, 30%, 10 billion. So there's been over the last 3 or 4 years much lower headroom. It's not a new turn of events. Presumably, if we were to expand it up to, say, 30 billion, that would involve a significant blend of tax rises and spending cuts. What would be the outcome of moving too quickly on that?
I suppose those are all decisions for chancellors of the day, as well as where they set their fiscal rules. Remember that a headroom is an artifact of where fiscal policy is set relative to the rules that chancellors set for themselves, and chancellors can choose to have tighter or looser rules. How much headroom they then leave against them once the rules have been set is a decision that they then make. So what we've seen in recent years is chancellors setting, to be honest, increasingly loose fiscal rules relative to the past. And setting aside against relatively loose fiscal rules, relatively little fiscal headroom.
Maybe it's a question for Professor Miles. If we carried out significant spending cuts and tax rises to get us back to the 30 billion, what would that do to growth in the short run?
I think it would depend on what the plan was to get back to a much higher number. So the number at the moment is a number in 5 years' time.
Yeah.
So a policy that sort of gradually had lower spending and some combination of that with higher taxes, and mainly happened, beyond, let's say, 2 years, and it was a 3, 4, 5 year program, would have a lot less of a negative impact than if you said, right, we're going to try and get to a current surplus, a current fiscal surplus by the end of this year. And that would be sort of pretty dramatic increases in taxes, cuts in spending. So the 5 year horizon, and it's 5 years at the moment, it's planned to become shorter, and it will become 3 years within a couple of years. Does mean that you could have quite a material impact on headroom without having to sort of slam the brakes on the car right now.
And if you slam the brakes on, that will be damaging to growth.
Yeah, slamming the brakes down generally is going to do a bit of damage somewhere.
And then the other thing some people are saying is the government should just increase borrowing. What would be, Professor Miles, the risks of increasing borrowing and an associated change in the Chancellor's rules?
Well, I think the risks are, and they're very difficult to judge, because you have to sort of get in the mind of the people that might buy gilts, or rather actually trying to get in the mind of people who would decide not to buy gilts if they thought that the government was going a bit soft on fiscal rules by borrowing a lot more. I mean, the government's going to have to issue a lot of government bonds, gilts, this year anyway. I mean, something like £300 billion. Historically an extremely high number, both absolutely and relative to GDP, and it probably has to do substantial amounts of issuing new gilts next year as well, and that's before you factor in the Bank of England running down its stock of gilts that it's bought. So one way or another, the UK government is going to have to sell an awful lot of government debt over the next few years, and the risk, and of course, nobody who buys gilts has to buy gilts. People can decide, well, I don't feel quite so confident about the UK. I'll buy them at a price, but that price is not an interest rate of 4.5%, say, on gilts. It could be 5 or 5.5. And with the stock of debt as big as it is, that has a material impact on the fiscal position. So I think one can see why a government might be wary of, we'll just borrow some more because we've had a bit of bad news, and don't adjust on other margins.
And if I've got this right, if the government borrowing costs increase, so say it's 5.5%,
Yeah.
for example, that would feed through to the public finances quite significantly because we've got a large amount of debt, it's almost 100 to GDP, so we're quite unlike Germany. But also, because of the way people price private sector debt and equity, it would increase the cost of debt and equity for businesses developing houses or investing in wind farms, for example, which would feed through to consumers. And it could be very damaging for economic growth. Have I understood the broad contours of this issue correctly?
Yes, I think you have. I mean, a generalised rise in the level of interest rates is not just going to affect the government payments on the outstanding stock of debt. It's likely to have knock-on effects on the cost of borrowing money for households on mortgages, for companies borrowing through the banking system. So it's not just the impact on the government fiscal position.
So if I've got a family who've just bought a house in Mount Vernon in my seat, it's in their best interests from the point of view of their mortgage rates that the Chancellor of the Exchequer does not radically increase borrowing.
Well, I think it's in everybody's interest as the Chancellor of the Exchequer and the government is wary about the potential knock-on impacts on the cost of borrowing. It would depend on what your constituents' mortgage situation is, whether they'd fixed the rate for a long time or not. But chances are they probably haven't fixed it for 5-10 years. It might be just a couple of years. So 2 years down the road, if it were the case that gilt yields and the whole level of interest rates were 50, 100 basis points higher, and I'm not saying that's going to happen, but if it were to happen, I mean that's going to affect the cost of their mortgage when they remortgage.
Thank you very much, Professor Miles. Thank you, Dame
Thank
Meg.
you very much. Dr. Stevens-Andrew.
Thank you. I'll try and be brief. Mr. Josephs, can you tell me how much the impact of changing interest rate forecast in your budget impacts the fiscal space the Chancellor has in year 5? Just qualitatively, not quantitatively.
Yeah, well, so as I said earlier, the increase in interest rates that we saw compared to our last forecast in October was around 50 basis points, sort of on average. And that was enough to eliminate the fiscal headroom the Chancellor had in October, which was about 10 billion. Looking forward, we've got some sensitivity analysis in the book which shows that a 0.6, 60 basis point increase would be enough to eliminate the headroom.
And how does the OBR forecast interest rates?
Well, we take market expectations.
And on that, there's been quite a lot of volatility in market expectations recently. I think 0.5% of the standard deviation. Do you think that change in interest rates might be noise rather than signal?
Sorry, I just
the
missed
change in interest rates might be noise rather than signal, in the sense of it's moving around quite a lot.
Well, it's certainly the case that interest rates have been very volatile recently, and again we have some analysis in the book of the kind of range that we've seen since our last forecast and the impact of if interest rates were at sort of either end of that range, what it would do to the fiscal position. I mean, it's certainly the case, as you say, that volatility adds a significant amount of uncertainty to the forecast. We take our market expectations over a 10-day window, so that sort of average of market expectations over that window, which aims to try and smooth over a bit of that volatility, but obviously can't get rid of all of it.
Yeah, so by extension, the 10-day period you're choosing has a huge amount of impact on spending decisions in 5 years' time. I'm not blaming, obviously there is a huge amount of volatility in both. Like the 10-day period you choose at this point in time is having a huge impact on spending decisions and indeed tax rises possibly later on.
So, well, yeah, I mean, the 10-day window is what we use for the forecast, and as I say, that has a big impact on the fiscal numbers, given the sensitivity of the public finances to interest rates. We do sort of reserve the right to adjust that if after we've taken the window there's been a big change one way or another, which we think, going to your point, is sort of signal rather than noise. That's not been the case this time. I think rates now are around, I think just 10 basis points or so higher than the window we took.
You also tend to forecast other bits, and you tend to use your forecast model to come out with the other outputs. But for the interest rate assumption, you take the market forecast. Why is the difference?
Well, I mean, I think that for us is the best source of information on the future path of interest rates. We take a similar approach for other kind of market determinants. So, for example, for energy prices, where you have a very liquid forward market, we use market expectations for energy prices as well. So it's not just an approach we use for interest rates. We use it in quite a few other areas of the forecast.
That's very helpful. Thank you, Mr. Josephs.
Thank you very much indeed. Yuan Yang, MP.
Thank you, Chair. We're going to move on to a set of questions around the welfare reforms. And I note that in the preface, you've written that there are details of the policy package sent to you very late in the process, and late notice of changes and incomplete analysis hampered your ability to reflect these measures. So to begin with, I want to ask about the timeline itself. You set out very clearly that on the 12th of March, the Treasury gave you a final package, or what you thought was a final package of measures. On the 18th of March, you sent them a near-final fiscal forecast. On the 19th, one day later, you received final policy decisions from the Treasury. Just looking at that process overall, how normal is that timeline? Were there surprises on your side or on the Treasury side to each other's movements, Mr. Joseph?
Yeah, thanks. So, the basic timetable that we've set out in the forwards is the sort of standard timetable that we use for all events, and most of it was followed sort of in the normal way, and the process ran smoothly. The exception that we've highlighted in the forward was just on some of the welfare reform policies, where the information on the costing of those policies we received later than is normal. And in some cases, the amount of information and analysis that was provided to us by the department on those costings was sort of less than we would normally expect. I mean, it might be useful just to go back to the questions that were being asked at the start in terms of how that process works. So policy costings, i.e. the impact of policy on the fiscal numbers, what we call the sort of direct effects, those are produced by government departments and owned by government departments, the department responsible for the policy. And our role is to certify that we think that costing is reasonable and central. And so there's always an iterative process where the analysts will send us their estimates. We'll typically go back and ask for more analysis, more evidence, and we'll typically ask them to change the costing. And eventually we get to a point where we agree it's reasonable and central, and we put it in our numbers. So that happened on this one, sorry, but it just all happened later.
Can I just clarify, when you say the department responsible, is that a conversation between you and DWP, or in this case it's the Treasury?
On welfare, it's DWP who produced the costings.
And you mentioned that some of those costings were incomplete, or some of the analysis was incomplete. Could you go into a bit more detail about what was lacking? What would you have needed to make a better or fuller forecast? Yeah,
so we received some of these costings later than normal, and with less evidence and analysis than normal. In particular, on some of the behavioural judgments that we need to make on these costings. So that relates to how those people affected might respond to the changes that are made, which is quite a complicated thing to model. So you're trying to anticipate, for example, if a benefit becomes less generous. So an example in this package is the government has made the universal credit health element less generous. That has a direct impact on the amount of the cost of the welfare bill, but you might also expect people to respond to that, so it becomes a less attractive benefit, less financially attractive benefit, and therefore some proportion of people will face an increased incentive to work rather than claim that benefit, for example. So that kind of analysis was not as complete as we would normally expect, and therefore we have we did do that assessment, but we've said that the costings are kind of even more uncertain than normal because we didn't have the usual amount of time and evidence that will allow us to do that.
Does that mean that we'd expect an update to those forecasts in the next in the autumn outlook?
So in our next forecast, we will do a fuller assessment of the costs of those policies. It's also the case that the Green Paper on welfare reform set out a very wide range of reforms, some of which we have included in the numbers in this forecast, but some of which we haven't, because the government did not set out final details in the Green Paper, which, I mean, and that's normal practice. Some of the policies they will be doing further consultation on. Some of the policies are just at a very early stage of development, and they will announce further details. And so in the autumn, whenever our next forecast is, we will look back both at the costings we incorporated in this at this event, but also likely to have the final details on the whole wider set of policies that we will also incorporate.
So in the autumn, just to summarise, you are likely to...
Carry on.
So in the autumn, you're planning to bring the forecasts related to the employment support package, which was not scored this time, and then also related to the behavioural changes and other parts of the welfare packages which didn't come in sufficient detail.
Yeah.
Is that the right?
So I guess there's a couple of different elements of this. So there's the direct impact of these policies on the public finances. There's also then the indirect effect, what we call the indirect effects on the wider economy, and in particular, in this case, the impact on employment and labour supply. And we did not make any assessment at this event of the impact of the welfare reforms on labour supply, because, again, we were not provided with enough evidence that enabled us to do that, and we didn't have time to do an assessment ourselves. So we will do that in the autumn. Again, as I said, also once the wider set of policies have been finalised, will allow us to do the sort of a full job on that.
Do you plan to publish any analysis of welfare-related changes before the autumn? I note that in previous summers you've also published papers describing the overall trends.
I don't think we've got any plans at the moment to do that. I mean, I think, as I say, some of the timing on this depends on the point at which the government finalises some of its policy decisions on the wider package. There are some pretty big reforms in the Green Paper that we did not include in any way in this event. So, for example, the government has said that it's going to scrap completely the work capability assessments, which is the criteria currently used to assess whether people get the universal credit health element. We've not made any assessment of that at the current time, but that potentially could have some pretty big implications. It's also said it's going to do a full review of the personal independent payment assessment criteria. So I think, yeah, anything we do will essentially depend on the timing around when the government makes its final decisions on those policies.
A final question. In the play of events from the 17th to the 19th of March, was there any surprise on either side? Were you surprised by being given more measures to score? Was the Treasury surprised by what you had given them? Was there a level of kind of... could you explain kind of what was happening in those few days? But perhaps for Mr. Hughes.
I mean, our forecasts are always full of surprises. We were forecasting in the middle of COVID. We were forecasting in the middle of Russia's invasion of Ukraine. Things always come up which are unexpected. In this case, as Tom was saying, we agree a set of deadlines for notification of measures, and so that we've got time to do our scrutiny properly. Those deadlines in this case were not adhered to, and a number of measures were notified to us after the deadlines were agreed. We did our best to provide our best assessment of
those. Said that the Treasury knows how our forecasts work, and Mr. Josephs, you've lent very heavily on the word normally, and it's later than normal. I haven't quite added up how many times you said that. So why was it, do you think, that given that the Treasury, the DWP, knew the deadlines, knew what was normal, that you got it all so late?
I think that's a question for the Treasury. We received it when we received it. I mean, I should say they know how our macro forecasts work, but in the end, we have to make. I mean, the job that we do and the job that Tom does in particular is make a set of. I mean, we have a pretty consistent track record that people can look at about how we treat different kinds of tax and spending changes, and wherever we can, we try and be as transparent as we can about explaining how those judgments work, what models we use, what elasticities we use to estimate different behavioural responses. But in the end, there are discussions that we have with the department and judgments that we have to come to make sure that our judgments are central, and we also try and learn from that experience, because oftentimes those judgments turn out to be wrong and we have to adjust and think, actually, we got it wrong last time, and so we've got to take a different view this time around.
I mean, do you think there must be a bit of gaming in this, because everybody knows the deadlines, and the planning stuff's recorded this time. The welfare stuff will now be scored likely in the autumn, which gives potentially impacts headroom. I mean, do you think that any of that has happened in this case?
I don't know. I mean, I think what we try and make sure is that the risks around our forecasts are symmetric, and you know, to the extent that things go up or down, you know, the changes that we make to our judgments aren't biased in one direction or another. So we're not sort of consistently optimistic when we first look at it and then revise it down, or consistently pessimistic when we first look at it and revise it up. So we try to make sure that, especially when we're revising judgments around costings, those judgments go in both directions.
Can I just say something? But I mean, it's quite clear directionally whether the quantum there's a consensus on or not, is going one way or the other. Nobody's saying out there, even the government themselves, in terms of their impact assessment on the Employment Rights Bill, that it's going to be anything other than a cost of up to 5 billion. So, you know, surely there must be a sense that you can make around the net effect of those that are sort of held back, that are going to be negative in future, and those that have been moved forward that are going to be positive, as in with the planning and infrastructure thing.
In some cases, I would say with a package like this on welfare reform, there's a bunch of different reforms to benefits as well as reforms to support being provided, and a number of different incentives going in different directions. So I think you do have to look at those things in the round. In other areas, as David was saying on trade, putting in place more restrictions on global trade around the world is not going to be good for global output, and it's pretty reasonable to say the direction of that is going to be down, with the exception of a few kind of limiting cases.
Thank you very much. Bobby Dean, MP.
Yeah, just probing on this a little bit further. So your answers around the uncertainty of the indirect effects, particularly on the labour market, is similar to an answer the Chancellor gave me last week in the response to the spring statement. My question to her, and I guess my question to you, is whether it could also go in the other way, because the idea of the Chancellor's pitch is that this is going to end up with more people in work, so actually this is going to end up having an improvements to the country's finances overall. By the time you get to the autumn forecast, things should look better. But are there risks going in the other direction, you know, impacts on public services or so on?
So specifically on the welfare reform package, as I said, we have not made an assessment at this point of the impact on employment. And I think it is difficult to say at the moment what the overall impact would be, because there are different parts universal credit standard allowance received by around 7 million families. An increase in the generosity of that might reduce work incentives, but I mean it's quite a small increase, but it does apply to a lot of people. Going in the other direction potentially is the fact that the universal credit health element has been made less generous. That potentially increases work incentives, and the changes there are bigger, but they apply to a smaller population, but also a population that is more distant from the labour market typically. So the sort of balance of those two effects is not clear cut. There's also funding for a relatively large employment support programme. You know, you would expect that to be positive in terms of employment, but the scale of that really depends on the detail, and past experience is that it's quite difficult to get really big results from those employment support programmes. And then, as I said, there are also just a lot of other elements in the Green Paper where the government has not finalised the reforms yet, and so it's very difficult at this point to gauge what the employment impacts might be. So that's why at this point, we've not done an assessment, and
I totally understand you haven't done the full assessment. I'm just trying to get a sense of the direction. You said there is pressure in both directions, but it feels to me that in the net it should end up being, I guess, positive for the public finances overall, but maybe not to a large extent. Or do you think there is a risk that this could end up declining the headroom by the time you look at this?
When you say positive for the public finances, it's certainly the case that the package has generated, a quite significant saving in welfare costs. The bits that we have scored already add up to around a £5 billion saving, so that's a significant saving. But the wider employment effects and then the knock-on that might have to the public finances is where we're saying the net impact is unclear. Yeah.
And is that at all to do with the fact that the large bulk of the savings have been driven by changes to PIP, which obviously isn't exclusively people out of work, it kind of applies to people in and out of work. So does that add greater uncertainty about the employment benefits? I guess I push on this because a lot of the press coverage we've seen over the last week has been betting big on the fact that actually these welfare reforms are going to drive lots more people into work and it's going to have a substantial impact on the economy.
So the changes to PIP, personal independence payment, are the element that's had the largest fiscal saving.
Yes.
Essentially making the criteria to become eligible for PIP more difficult in the future. And our current estimate is that around 800,000 people who would have been eligible for PIP will no longer be eligible for PIP over the 5 years. Again, the impact on employment of that we have not assessed. Yeah. And it is difficult to make an assessment because, as you say, it's not a work-related benefit, and obviously a large proportion of people who do have claimed PIP are quite distant from the labour market.
Yeah. Okay, thank you.
Thank you very much, Luna McAvoy MP.
Thank you, Chair. I just wanted to come in on the 800,000 figure. So in your 2024 Welfare Trends report, which I actually thought was a fascinating read, read it a few times to get my head around it, it explained about people and the increases to claimants coming from often transitioning from legacy benefit systems, and how the numbers seemed to total a higher number when it was explained on a graph. You could see that those people were already in the system just under a different benefit name. I just wondered if, with your 800,000 people being affected who would have been eligible for PIP but are no longer eligible for PIP, is that based on the trajectory including those legacy benefit increases, or with the legacy benefit increases taken away?
Well, so the Welfare Trends report, which I'm very glad you enjoyed, was focused on incapacity benefits primarily rather than PIP, although we did include some analysis of PIP in there as well. And there has been over the last few years a kind of transition from the previous system essentially to universal credit. So I think what you're referring to there is there was a big transition from people on the old benefits into universal credit. But in addition to that, what that report shows is there has been also a big increase in the underlying number of people on the caseloads, in addition to that transition. And as Richard was mentioning earlier, there are a number of probable drivers of that. It seems quite likely that part of the reason is that the underlying health of the working age population has declined. The working age population is ageing due to demographics, but also there is evidence that even amongst younger population, issues such as mental health conditions have increased over the past few years, and that's probably driving some of the caseload increase in the forecast. But we also think it's quite likely that economic factors are driving it as well. So in particular, cost of living pressures since the pandemic clearly increases the financial incentives to claim these benefits, which are much more generous than the standard allowance under universal credit. And what the Welfare Trend Report also shows is that it's also quite likely that just changes in the operation and structure of the system have also contributed to that.
Yes, so I thought that was very interesting how, I think in chart 3 in that report, it said that 20% were new people.
Mm-hmm.
So new people actually claiming, and the other changes in the increase was due to, the biggest significant one from 2018-19 to 23-24 was due to a lack of drop-offs. And I wondered if you could elaborate a little bit on that.
Yeah, so this is the increase in the caseload roughly since the pandemic. As you say, what that analysis shows is that a small part of it is just more people putting in claims, but the bigger part of it is two things. One is that fewer people are dropping out during the sort of assessment process, and the second is that approval rates are basically higher. I mean, it is difficult really to understand why those things are happening, and we're hoping we can do some further work on that with more data from DWP. I mean, it could be because, going back to the point I was making earlier, people are coming with worse health conditions, which means that they're less likely to drop out and the approval rates are likely to be higher. But I think it seems likely that is not the only driver, and that there are also just other factors within the kind of operation of the system that have been driving that trend as well. I mean, financial incentives is also like potentially a driver of that. I mean, if people have more of a financial incentive, again, they are potentially less likely to drop out, and I'm sure the financial benefits of these will be something that assessors are also factoring in when they're making their decisions.
Yeah, I'd be interested in that, because when you speak to somebody who is in receipt of any of these benefits, they don't say that it's an easy process. Mm-hmm. It's a very complicated, difficult and strenuous process, mm-hmm. especially if you're disabled or unwell. So can you just for my clarity, two things. On the final point that you just said then, you said that the financial incentive from the assessor's point of view, because I think in 2017 the last government brought down a sort of mid-range universal credit element that was for, was it limited capacity to work, rather than mm-hmm. limited capacity for work and work-related activities. Yeah. And because the that was brought down to the same level as standard universal credit, we ended up with the higher rate seeing an increase. Yep. Do you think, can you just elaborate a little bit further on what you think about the assessor's point of view on that?
I think the point you're making there is that what you saw after that change is that approvals into the higher group increased quite significantly. We do not have any sort of clear evidence on assessor behaviours, I should say. So it's not something I can give you a very sort of definitive answer on, but
it's a perverse outcome from an intent, potentially.
Yeah. And just the final point, just to be 100% clear, on your projections where you've scored the welfare changes, you haven't included, on the trajectory of increased cases, you haven't included legacy cases going into the system, the transition from old system to new system.
Yeah, so that is in the baseline forecast. Yeah,
it is. Yeah. Okay.
Thank you very much indeed. Yuan Yang, MP.
I wanted to continue one of the themes that Ms. McAvoy brought up, and in the 2024 welfare report, and I think elsewhere in the OBRAP publications, you talk about the term financial incentive to apply for claimants, and I think there's a lot of stigma in the media right now about fraud and kind of incorrect claimants, or gaming the system, as it were. Mm-hmm. I think that term can be understood in a variety of ways. So I was wondering if you could just explain a bit more, by financial incentive, how do you see financial incentive to apply or to kind of stay in the system and to not drop out, relating to the kind of broader kind of issue of, say, fraudulent claims?
Yeah, well, so we're not, in the assessments we've made of the welfare reform packages, when we've looked at responses, we're not really looking at whether people are going to make fraudulent claims or not. What we're looking at is purely how people sort of respond to the different financial incentives in the system and the various changes that have been made to the gateway assessments into the benefits. So there is a much more generous award for people who have health and disability conditions compared to people who don't. And part of the government's sort of stated aim of their part of the reforms was to start to sort of narrow that gap. I guess the area where this was the sort of biggest consideration in the assessments that we made at this event was around the impact of the changes to the personal independent gateway criteria, where essentially the government tightened the criteria to make it more difficult for people to become eligible for the benefit. And if you apply the sort of new criteria to the past results of the assessments that have been made, and DWP has a record of all of the past scoring that people have made against the criteria, then that led to an assessment that around 1.5 million people would no longer be eligible for the personal independence payment. But we then assume that in the future, people will respond to the new criteria, given the financial incentives, and that people, will be able to bring forward new evidence and demonstrate that they are able to meet the new criteria, which they might not have done in the past.
So people will put more work into getting the right doctor's assessments and so on. So there's no claim from the OBR's behalf of that evidence being mistaken, but that people will be driven.
Yeah, I say we're not. This is not about sort of fraud. It's about people's incentive to provide evidence and the assessments that they make of themselves and their conditions against the criteria, the sort of advice they might receive on that, and again also a bit about how assessors might respond, because the criteria are ones on which a judgment needs to be made. It's not a kind of clear-cut division. It leaves room for a lot of judgment, and that, as I say, is like we think will lead people to.
So finally, is that there is also the implication, I think, in a lot of media discourse that the increase in PIP caseload is not matched by an underlying increase in disability, and therefore there is some gaming. I was wondering if you see that in the data that you've looked at.
Well, Richard spoke on this earlier. I think that there is evidence that there has been a deterioration in some areas of working age population health, particularly sort of starting around 2018 and then after the pandemic, and particular evidence of an increase in mental health conditions amongst, in particular, younger parts of the working age population. But it also does seem the case that is not the only driver of the increases in caseload that we've seen since the pandemic. As I was saying earlier, it does look like there are also sort of economic factors that may have been driving that, and potentially issues around the operation of the system as well.
Thank you very much indeed. Rachel Blake MP.
Thank you very much, Chair. I want to come on to one of the other policy measures, which is around house building. Last time we were here, you said that you didn't have enough detail to do the scoring, and now we're seeing a material, additional and durable impact on transactions and potential output. I just wondered if you could, I think it will be Professor Miles, talk us through some of the methodology that got you to the point where this could be scored.
Professor Miles.
I mean, we looked at a range of evidence. One was to speak directly to house builders about how they saw it and what they were going to do. And certainly amongst the larger house builders, and they were the main ones we spoke to, not all of them, but the ones we did speak to, there was a pretty positive response as to what they would do, certainly in the longer term. They were keen to point out, which seemed very plausible, that there would be time lags between new rules and when they actually started building more houses. So that was perhaps our single biggest source of information.
Can I just pause you there?
Sure.
So what happened between them saying, yes, we quite like this, and you able to put some numbers to it?
Well, I mean, we got some detailed information about where grey belt land, i.e. land that was previously green belt and you really couldn't hope to develop it, where grey belts might be, and the incentives, just numerically, money-wise, what incentives there might be if land that you couldn't build on now became available. And those incentives look pretty strong, depending on where you were in the country. I mean, they were stronger in the southeast than they were a long way away from the southeast. We had a sort of long, hard look at capacity constraints in the residential construction sector, which in the short term seem very material, and they add up to a kind of time lag where essentially our central forecast was that you got very little boost to house building this year and not a whole lot next year, and it really was backloaded to the sort of years 3, 4 and 5 in our forecast horizon. But it seemed pretty clear that whichever way you looked at it, if as was very likely to be a side effect of the new planning rules, there was land, particularly in the southeast, that you just hadn't been able to have a hope of building on before, that now there was a realistic prospect of doing it. Given the difference in the value of land, if it was, let's say it's agricultural land, relative to what it would be if you developed it as housing, I mean, in principle, there's a very big incentive now. And, I think we've probably all heard for several years house builders saying, we're held back by this aspect of the planning system or that aspect of the planning system. The quantification of how big and how quickly it comes through is something about which it's difficult to be very precise. And our numbers are that by the end of the forecast horizon, which is 5 years down the road, something like 70,000 on our central estimate more houses would be built than otherwise would have been built.
Do you anticipate scoring the planning and infrastructure bill?
I think it depends what detail we get on it. I mean, the residential stuff was much more developed, and it was very clear what some of the rules were. We're not in the same place on the infrastructure stuff. When we get more detail, we certainly will look into that.
So it's feasible that development corporations might be scored, because they would, in terms of decision making, they could move forward development quite. Yeah,
I mean, we're open-minded once we get more detail on the thing to look at it and see what size of effect we might get.
And there was a particular element to the overall market that I wanted to get to with you. So in London in particular, £4 million a day is spent on temporary accommodation, which is private rented accommodation that local authorities lease. Is it possible for you to forecast and to model the impact of a reduction in that in terms of any positive growth, or is that...
So a reduction in which elements?
Temporary accommodation.
In temporary accommodation costs. So that's a
do you mean as a side effect of the planning reforms?
I take it it's not...
Yes, in the sense that we have an estimate of how much lower house prices, and therefore rents, are likely to be as a result of building the houses. Yes, it is. Now, because although it's quite a big impact on the number of new houses built, the impact on things like rents and house prices depends on how much you move the stock of housing. And because obviously the flow of new house building is small relative to the stock, even though you have a material impact on house building, on the stock, even 3 or 4 or 5 years down the road, it's not an enormous impact. Therefore, the house price and rent knock-on impact is pretty small. It builds up over time. I mean, it'll be bigger in 10 years than it is in 5 years, and it's bigger in 5 years than it is in 2 years.
But it would be fair to say that that impact on rents, that's the closest that you would get to, and the costs of local authorities, the cost to local authorities isn't something that's at the moment played into your modelling.
I think it's too limited in an impact to have a sort of material effect over the forecast horizon, that element of it.
You need to have a very clear figure of social housing, presumably, in that to be part of that.
I think you would. You'd need a very clear idea on that. Yeah.
And geographically.
Definitely geographically, yes. I mean, we've skewed our estimates about where the house building comes and what the size of the effect on the economy is. We haven't assumed that there's just going to be more house building evenly spread across the country, that there are incentives for it to be, there are stronger incentives in the areas where house prices are higher.
Yeah, okay.
The southeast.
A bit short of time, so perhaps another couple of...
Yep.
So I just wanted to understand in detail with where we lost those 200,000 from the government's target, and you forecast 1.3 million.
I mean, lost in the sense that I think it's significant to a significant extent. It's about time lags. That we don't think there's likely to be any impact on the scale of house building. Certainly not this year, and possibly not even for most of next year. Therefore, you don't build up to 300,000 houses built in the UK until year 5. You're short of that along the way. And that's the major reason why you don't get to the government's target. And you get closer to it by year 5, and we think that those effects are likely to be persistent. I mean, unless there's further changes in the planning system, and they'll last beyond year 5. And we come up with some estimates of where you get to beyond year 5.
Are you able to determine whether it's more in terms of land supply or the capacity in the sector, or is it an aggregate of those two factors? Because obviously you can move capacity in the construction sector more easily.
I mean, it's the effect of both things combined, in a sense that, you know, if you have more land but there isn't the capacity to build houses, that's what holds you back. If you've got the capacity to build houses but you just can't have the land with the permission, that's going to hold you back. In the very short term, the time lags are both about getting the permission and about building up capacity in the industry. I mean, once you look beyond a few years, even though there may be shortages at the moment of people in the construction sector with the relevant skills, you then start trying to address questions about apprenticeships and training people. And that's likely to be, I mean, if house builders believe that these are the new rules of the game, they're more likely to expect stronger demand in the future, more willing to take on apprenticeships and train more people, which they might not if there hadn't been the planning reforms.
Thank you very much.
Thank you very much indeed. I just wanted to go back, if I could, Mr. Hughes, to the issue of the released information about your forecast. When the final submission was sent out, about 102 officials, mostly officials from the Treasury, ministers, 6 special advisors, the head of the special advisors office, who may be a civil servant. I mean, some SPADs are civil servants technically, but I think they're a slightly different category, and some press officers were included in that list. But prior to the leak or release of information on the 11th of February, among the meetings you had 4 that included special advisors. Was that the same special advisor at every meeting, or was it a different mix of those 6 people?
I'm trying to think back. We had 2 meetings which included special advisors alongside officials, and then 2 meetings which were with special advisors and ministers. My recollection was it was all the same special advisor, but
it was one special advisor.
I believe so, yes.
Okay. Are you able to tell us the name of that special advisor?
I think you could ask the Chancellor, who was in meetings with it.
And an email, just for record, an email went out on the 7th of February, which didn't actually copy in any special advisors. It's just differential. We've had 15 years of the OBR. There's never been a leak of information. And you're very clear it's not from your team.
I'm very confident.
We've obviously been asking the Treasury about this as well, just to get that on, helpful to have that clarified. And just to be clear that while we've been sitting here, the UK Statistics Authority and the Cabinet Office have announced a review led by Sir Robert Devereux of the UK Statistics Authority. So this is an issue that we are pursuing with our sister committee. And I think it's been a really useful session, so thank you very much for your time. In summary, we've learned that various Chancellors' decisions to leave themselves very little headroom means that much greater attention is paid to small changes in your forecast. We've heard, as we have heard from the Bank of England, that the uncertainty around the ONS data is affecting your forecast. So the review, I think, is welcome to us all. And we heard, of course, that a 50 basis point increase in interest rates was sufficient to use up the Chancellor's headroom. So we're working on quite small margins here. And also, an area of interest to us before this, and thank you for your answer on it, the Treasury missed the pre-agreed deadlines for submitting policy changes, which prevented you forecasting or including the changes in your forecasts. Even when these are clearer, we heard from Mr. Josephs that there are challenges in determining the impact because of the complexities of interactions with the various welfare changes. So that's something to watch in future. But thank you very much indeed for your time. The transcript of this session will be available on the website uncorrected in the next couple of days. Thank you very much indeed. Order, order.